Welcome to Smart Wealth with Joshua, and Merry Christmas to you.
Your daily stock analysis and catalysts talk. Today we're looking at Starfighters space.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, let's unpack this one. Starfighters space, they're the new name on the block, focused on commercial supersonic aircraft and satellite launches.
That's right. And they are a fascinating case because they're so new to the public markets. They just listed on December 18th, 2025.
So really recent.
Extremely. Which means we're dealing with a story that's almost entirely built on future potential, not, a long history of public financials.
So what's the foundation of that story? Where does it start?
It starts with the IPO. Just before they listed, on December 17th, they completed a capital raise. A big one. $40 million.
$40 million, okay.
And what's really fascinating here is how that cash infusion just fundamentally bolsters their balance sheet right out of the gate. And from what we can see, all the available data suggests they came into the public markets clean. No disclosed pre-IPO debt load.
Which is a really powerful starting position, especially for a capital-intensive sector like aerospace.
Oh, excellent.
But that does bring up a question. A blank slate and $40 million sounds great, but this is a high-growth, R&D heavy field. How fast are they going to burn through that cash?
That is the critical question.
Yeah.
The funds are immediately earmarked for two key areas. First, R&D for their Star launch programs.
Okay.
And second, scaling their operations. There's just rising demand for low Earth orbit launches, and they need to meet it. Management's guidance is pretty clear that this is all designed to drive long-term free cash flow generation.
Let's slow down on that for a second. Free cash flow. For anyone less familiar, why is that the key metric here and not just, say, revenue?
Good question. Free cash flow, or FCF, is the cash a company generates after it's paid for everything. Its operations is big capital expenditures.
The real cash left over.
Precisely. For a company like Starfighter Space, with massive upfront costs for jets and launch sites, FCF is the gold standard. It shows they can fund their own growth without constantly running back to the market for more money.
Got it. And management thinks that $40 million will bridge them to that point.
That's the belief. It should get them to a sustainable point, and it even includes potential expansion plans, maybe out to Midland, Texas.
But since they are so new, we're not going to find the usual reports we dig into, right? No 10K or 10Q just yet.
That's exactly right. You're flying a bit blind on historicals. The 2025 revenue figures, that's largely speculative in the public domain. The market is trading on the growth narrative.
And what's driving that narrative?
It's strong. Analysts see huge potential, and it's being driven by emerging partnerships and some real advancements in space tourism. So the expectation is for early revenue to accelerate pretty quickly, even without a lot of disclosed financials right now.
Okay, so if we're buying story about the future, their competitive edge, their moat, has to be incredibly strong.
It has to be.
So what is it that sets them apart from what feels like a rapidly crowding field?
It's built on two things. First, unique assets. Starfighter Space operates the world's largest commercial supersonic aircraft fleet.
The largest, okay.
And second, proprietary access. They run these operations directly from NASA's Kennedy Space Center.
Now here's where it gets really interesting. That access to NASA's infrastructure, that's not just a nice little detail, is it? It's a massive barrier to entry.
It's almost impossible to replicate. It means they control a critical choke point in the launch process.
Explain what that means in a practical sense.
Well, launching anything, especially sensitive satellites, requires specialized facilities, regulated airspace, experienced teams on the ground.
Right.
By operating from Kennedy Space Center, they get proprietary access to all of that infrastructure. It's something very few commercial companies can match.
Just think about the regulatory hurdles alone, not to mention the cost. This creates extremely high switching costs for their clients.
Absolutely. If you're a startup and you need frequent, cost-effective launches, are you going to build your own infrastructure? No. You're going to go with a company that already has the keys to the kingdom.
And this ties right back into their whole mission, doesn't it? To democratize orbital launches.
It's the lever that makes that promise a reality. They're positioning themselves as the go-to facilitator, making space access cheaper and more frequent for everyone, from entrepreneurs to government agencies.
So it's not just about having the best rocket, it's about having the keys to the best launch pad.
Exactly. That's the business model.
Now, we have to talk about what happened when this story hit the open market because, wow, the price action has been something to see.
Volatile is an understatement. We are talking about extreme price action.
I mean, we saw an initial surge from an all-time low of $5.99 all the way up to an intraday high of $17.72 on December 17th.
And it closed that day at 1833. That kind of swing should be an immediate red flag for any investor about the risk involved.
And the ride didn't stop there. We've seen a huge pullback since then.
A very significant one. A drop of about 42% on extremely high volume. And this is where the technical analysts start, drawing their lines in the sand.
Offering two very different interpretations, I'm sure. What are the two sides?
One side says, look, this deep pullback proves it's a high-risk, penny stock profile. A lot of hype, then the fast money gets out.
And the price collapses.
Right. But the other side, and this is where a lot of the technical folks are leaning, suggests this is actually a necessary basing pattern.
Okay, for our listeners, what exactly is a basing pattern and why would that be seen as a good thing?
A basing pattern is when a stock, after a huge run-up, consolidates. It finds a floor and trades sideways for a bit.
Yeah.
It clears out the weak hands, the quick profit takers.
It sets the stage for a healthier move-up.
Potentially. It's seen as a constructive accumulation phase.
So defining constructive accumulation, that means larger investors, the ones with a longer view, are seeing this drop as a chance to buy in without immediately spiking the price back up.
That's the theory. And the fact that we saw those huge pre-market volumes and that intraday high of 2266, the fact that happened alongside this consolidation is what analysts see as constructive. It signals that deep down investor interest is still there.
I have to jump in with a word of caution, though. A 42% drop is brutal.
It is.
And it really highlights the extreme risk. This isn't some stable blue chip. This is high-octane speculation.
No question. And we will get to the bear case. But just sticking with the technicals for a moment.
Yeah.
Analysts are suggesting that support is now forming near those recent lows.
In what range?
Specifically around the $15 to $18 range. They see this as a potential entry point for momentum traders.
Why that range in particular?
That's where a lot of the initial high-volume trading happened, right before the big drop. So there's some price memory there, a likely floor. On top of that, many indicators are probably flashing oversold.
Meaning it's fallen too far too fast.
Exactly. And that can set up something called a hidden bullish divergence.
Okay, that's a big piece of jargon. Can you break that down for us?
Sure. Divergence is just when the stock's price and a momentum indicator, like the RSI, are moving in opposite directions.
Got it.
A hidden bullish divergence is when the price makes a higher low, but the indicator makes a lower low. In this context, it suggests that while the stock price has stabilized, the underlying selling pressure has really eased up. It can signal a reversal is coming.
Especially as news about these new partnerships keeps fueling interest.
Precisely.
So the technical story is high risk, high volatility, but some specific chart signals that suggest the stock is building a base for another rally. But charts are one thing, actual business catalysts are another. Let's talk about the forward outlook.
The sentiment right now is, as you'd expect, mixed, but overall, it's leaning optimistic.
And that's being driven by what?
Concrete news. A recent aerospace partnership has sparked a lot of growth buzz. You couple that with positive developments in the broader space tourism sector, and it's keeping interest high.
And of course, there's always the speculative chatter. I've been hearing rumors about major satellite launch scalability, expanded space tourism projects.
And a lot of that is fueled by the CEO's vision for democratizing commercial orbital access. But if we move beyond speculation, there's a pretty concrete calendar for the next 3 months.
Okay, lay it out for us. What should we be watching for?
First, earnings. Sometime in Q1 of 2026, we should get their very first quarterly report as a public company.
And that will be our first real look under the hood. Cash burn, initial revenue.
Everything. It's a massive event, a huge risk or a huge opportunity. Second, you have events. Watch for investor updates on the Star launch R&D and how they're scaling operations.
And I imagine they'll be showing up at industry conferences.
You'd have to think so. That can generate a lot of positive momentum.
And this is all happening against a pretty favorable macro backdrop.
Right, it really is. If we connect this to the bigger picture, we're seeing sector rotation into these high-growth space and aerospace plays, and, maybe more importantly, falling interest rates.
Which tends to help capital-intensive companies.
Greatly. Lower rates make borrowing cheaper, which is essential when you're funding things like a new supersonic fleet.
Right.
It also just makes long-term projects more attractive to investors. They're more willing to wait for a payoff if the cost of capital is low.
Okay, so we've painted a pretty comprehensive and mostly bullish picture here, but we have to address the bear case. We talked about the price swings from under $6 to over $22 intraday. That's a huge warning sign.
It is. It reflects that inherent high-risk profile. And we need to look at the immediate cause of that 42% drop. It wasn't just random.
It was tied to specific news.
Correctly. It was tied to reports of launch delays, and that just eroded near-term investor confidence.
So the market reacted instantly and very aggressively to an operational setback. That shows how sensitive the stock is to execution risk.
It does. But on the other hand, the new partnerships were announced around the same time, which signals the market might be willing to look past those delays toward future revenue.
So that raises the key question for an investor. Can they execute?
Exactly. Can they hit their launch schedule and manage this volatility? Having that $40 million liquidity buffer from the IPO certainly helps. It buys them time to smooth out these initial operational hiccups.
Okay, let's tie this all together for you, our listener. What does this all mean? Give us the elevator pitch for Starfighter Space right now.
The core pitch is this. Starfighter Space is in a unique position to capitalize on the commercial space boom. They're very well capitalized with that $40 million war chest and their operation from Kennedy Space Center. It's a significant proprietary advantage that is very hard for anyone else to replicate.
And from a trading perspective, what's the takeaway?
The volatility, as crazy as it's been, has maybe created a potential entry point near that $15 to $18 support zone. And with the catalysts coming up,
The Q1 earnings report.
right, and partnership updates, analysts are looking at this as a swing trade into that Q1 2026 period, so maybe a 3 to 6 month horizon.
So, as a final thought for you to take away, look beyond just the next quarter.
Yes. Think about the strategic implications of that Kennedy Space Center access. If Starfighter Space really does succeed in scaling their operations, if they truly fulfill that promise of democratizing space, think about how that could fundamentally change the economics of the entire low Earth orbit business over the next 5 years.
That's the real long-term story here.
It's much bigger than the current swings on the stock chart.
A fascinating company to watch. Remember to subscribe for our continued analysis and wealth insights.